as the Fed tiptoes close to saying we will have a recession next year.
So we got a pretty big update yesterday from the Consumer Price Index, or CPI data, that was just released for the month of November. Inflation for the month of October rose 7.7% year over year, which decreased by 0.5% from 8.2%. The economists were forecasting in the range of 0.2% to 0.5% with a consensus of 0.3%. And yesterday, consumer prices jumped 7.1% year over year, which was less than the 7.3% expected. That's really good news, right? The CPI reading for November was the smallest 12-month increase since December 2021 and was down from 7.7% in October. The CPI reading for all items rose 0.1% in November as shelter and food increased. And I'll get into the details of the CPI reading in a little bit, because as of right now, while I'm recording this video, the Fed is having their FOMC meeting. So we should find out what their final decision is on the interest rate hike in December 2022. The Federal Reserve Chairman Jerome Powell already said the central bank will likely show or slow the pace of interest rate hikes in December, but will continue to push rates higher than it initially planned. In November, they raised the rates by 75 basis points, and we're expecting the Fed to raise interest rates by 50 basis points. Now that the goods and services are coming down, I could see the Fed slow their interest rate increase going into 2023. And people like Elon Musk and Cathie Wood from ARK Invest are already warning that these interest rate hikes will create deflation and a devastating recession. Let's see how the Fed responds to the latest CPI data, whether they'll be hawkish or dovish. So before the interest rate announcement, let me get into the Consumer Price Index summary. The Consumer Price Index for all urban consumers, or CPIU, rose 0.1% in November on a seasonally adjusted basis, according to the U.S. Bureau of Labor Statistics. Over the last 12 months, the all items index increased by 7.1% before seasonal adjustment. The index for shelter was by far the largest contributor to the monthly all items increase, more than offsetting decreases in energy indexes. The food index increased by 0.5% month over month, while the energy index decreased by 1.6% month over month. Now, let me pull up the core categories. Eggs are up 49% year over year, and that's insane to me. And airfare, 36%, butter, 34%, public transportation, 24%, lettuce, 19%, cereals, 16%. Pet food, 15%, utility gas service, 15%, and milk, 14%. But if I scroll down and look at what's down year over year, major appliances at negative 1%, used cars and trucks at negative 3.3%, that's really good news too. And computers at negative 4.4%, beef at negative 5%, car rental at negative 6%, televisions at negative 17%, and smartphones down 23%. The average U.S. household spent $396 more per month to buy the same goods and services it did a year ago, which is down from $433 in October. But what I'm paying attention to is the downtrend of the CPI data. While energy commodities are down 2% month over month, used cars are also down 2.9%. Now, and the new vehicles are flat at 0%, and medical care services are down 0.7%. And I think it's only a matter of time before we start seeing a downtrend in shelters starting in 2023. The December CPI report will be released on Thursday, January 12th, 2023. The stock market reaction for Tuesday was initially bullish, but ended flat. And I think everyone else is waiting to find out how the Fed reacts to the CPI reading. The inflation reading so far is heading in the right direction. And January 2022 was 7.5%. February was, was 7.9%. And June was at the peak at 9.1%. It has now slowly decreased from 9.1, 8.5, 8.3, 8.2, 7.7, and now at 7.1%. Now, let's go with the Federal Reserve. And they're announcing the interest rate hike at 11 a.m. Pacific time. Is right now I'm recording this video. And what does it mean when the Fed raises interest rates, right? A lot of people always ask that. The most basic definition is that it makes borrowing money much more expensive with higher interest rates. And it means that the interest rates for credit cards, mortgages, student loans, personal loans, and car loans will continue to increase if you haven't locked in the fixed rates already. This is especially going to affect people with debt that have variable interest rates. But what's awesome is that my high yield savings account will most likely go up from 3% to 3.25 or maybe more, right? Maybe 3.25% or 3.5%. So a variable rate loan is a type of loan where the interest rates change based on the market interest rates. Your credit card lenders, for example, usually follow a financial index like the federal lending rate. And the banks need to make their profits, right? And they do that by creating a spread with the federal funds target rate. So if you're trying to figure out how to calculate the variable interest rates, it's usually the Fed fund rate plus the prime rate plus the bank spread. And if the Fed fund rate is at 4%, then the prime rate is going to be around 8 or 9%, depending on the spread. If your loan is, let's say, on a fixed interest rate, then you're going to pay the rate locked in at the time you sign for the loan. But this is what the Federal Reserve wants in order to reduce the overall inflation rate from 7% to 2%. They want to reduce the demand, and it's likely going to lead to a recession in 2023. And this is why you should never carry a balance on your credit card. You should pay off your bad debts like personal loans, student loans, and other high interest loans as soon as possible. And if you truly want to achieve financial independence and retire early, you need to work on increasing your savings rate. And are you really planning to pay off your student loan until you're 40 or 50 years old? You want to buy a dream house eventually and invest $1,000 a month instead of $100 a month, right? How about saving $5,000 a month instead of $1,000 a month? It's not possible if you're still carrying those debts. And I also encourage you to get my financial independence resources for free by visiting firesightchat.com/contact. And if you need help with your personal finances, like creating a budget or a savings plan to achieve your financial independence, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesightchat.com/coaching. All right, let's see what the Federal Reserve announces about the interest rate hikes. And let me tune into CNBC here. And let me know in the comment section down below if you enjoyed this type of content. I don't have the live stream set up in my studio yet after the flood, but I'm looking to do that in the future here.
50 basis point move to between 4.25% and 4.5%. But the median dot for the end of 2023 is 5.1%. That implies that rates will go up another 75 basis points. And 7 of the 19 members thought they should go higher than that. Not what global Wall Street is expecting. Supporting that outlook, there is no change in the Fed's statement's promise that ongoing increases in the target range will be appropriate. Rates start to fall in 2024. The median forecast at the end of that year, 4.1%. Although there is a lot of division, the forecast range from a low of 3.1% to a peak of 5.6%. Rates then drop to 3.1% in 2025, although one member still sees rates at 5.6% in 2025. The long-run neutral rate unchanged at 2.5%. The new economic forecast downgrade what is now seen as modest growth as the Fed tiptoes close to saying we will have a recession next year. They raise the outlook for inflation and unemployment. GDP for 2023 is seen at only 0.5 percentage point, down from 1.2% in September. 2024 is trimmed by 0.1 to just 1.6%. Unemployment ends next year at 4.6%. That's 0.2 higher than they had forecast in September. The same for 2024. Inflation remains elevated, the statement says now, with no acknowledgement of yesterday's decrease in the CPI. The Fed uses PCE inflation. The median forecast is that will fall to 3.1% by the end of next year, although that is higher than they saw in September. They saw 2.8%. It drops to 2.5% in 2024, 2.1% in 2025. Core inflation next year falls to 3.5%, up from September's forecast of 3.1%. The decision unanimous, so a much more hawkish Fed, at least coming out of the statement, than we had anticipated.
Mike McKee, thank you, sir. Of course, this is
Okay, so the market is not happy right now. They were up 270 points before the release of the interest rates, and the Fed is obviously more hawkish than before. So we're looking at possibly raising more interest rates going into 2023. And here's a statement that we got from Federal Reserve. Recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Talking about Russia's war against Ukraine is causing tremendous human and economic hardship. Okay, so the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Yeah, we all know that. They decided to raise the target range for the federal funds rate to 4.25% to 4.5%. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Okay, so it turned very, very hawkish. So that is the news. So we all expected that it was going to be 50 basis points, but we wanted to know where they stood going forward in 2023 and maybe even 2024. So yeah, this is going to be pretty interesting. And the market is not happy right now. And pull it up, and Dow Jones, right now it was up about 270 points before the numbers, the news came out, and then S&P 500 is down about 0.25%. And NASDAQ is about 0.5%. So yeah, it was a green day, and now it's turned into a red day. So anyway, if you enjoy this type of content, just let me know in the comment section down below. I'm looking to set up the live stream in the future for a big market update for something like this. And why we should care. If you're on a financial independence and retire early journey, you need to know what is going on with the news, what is going on with the macroeconomics, right? So if you're looking to retire in 2023 or 2024 that's coming up, you need to know what is going on with the upcoming economic outlook. So anyway, and yeah, so with that said, I appreciate you watching this video. And if you have any questions, let me know in the comment section down below, and I'll put up more videos at the end. And yeah, but peace.